Hello friends, welcome to Finance Lens. Today we'll be talking about two very important financial ratios, price to equity and price to book. The two ratio every investor must know. Let's take a case of Ramesh, who owns a chai business and his business is earning 10 lakhs every year for the last 5 to 10 years. And Suresh is ready to buy the business from Ramesh and is offering him 1 crore for a stall that earns 10 lakhs a year. Let's find out if it's a fair deal. In this case, you're basically paying 10x PE for the business, which is 1 crore divided by 10 lakhs. In this case, the higher the PE, the means the more years of profit you're betting on upfront. Let's find out what the market thinks on P ratio. There are three categories: low PE, fair PE, and high PE. Generally, the low PE category is 5 to 15x. In this category, you will find normally value picks or a fading business. Second category is fair PE. In this category, you will find mostly well-established businesses which offer predictable growth at a reasonable price. In the third category, basically you're betting on tomorrow and not on today's profit. This includes recently listed startups or any business which the market expects to grow substantially in the nearby future. That's for the P ratio. Now let's find out what is PB ratio, price to book ratio. For example, in this case, you're offering him 1 crore for the business, but if you sell the business, if you liquidate all the assets of the business, any furniture, store, any including the cash, everything, and liquidate everything, and you'll get 1.5 crore for the business, but you are offering him 1 crore. In this case, 1.5 crore divided by 1 crore is your PB ratio, which is 1.5x. Any PB ratio which is less than 1x means you're getting the assets for less than the market price of the business and is undervalued. So that's it for the PB ratio. Now let's summarize what is PE and PB ratio and the critical question you must ask when you are referring to the PE and PB ratio. Coming to the P ratio, the most critical question you must ask is how many years of profit are you praying for? Higher the P means higher the number of years of profit you're paying for right now. General thumb rule is if you're paying the higher the PE means the business is more expensive. Lower the PE means either the business is undervalued or there is degrowth in the business. Now coming to PB ratio, the critical question you must ask here is, are you paying more than what the company actually deserves? General thumb rule is if the PB is less than 1, the asset is cheaper than the price. Basically, the stock is undervalued. Now that you know about P and PB ratio, let's find out about return on equity in the next video. Thank you.